If you've got some extra cash sitting around and you're thinking about investing in 2026, this video is for you. By the end of this, you'll know exactly where to put your money, how to get started, and the biggest mistakes to avoid. I'm breaking down everything from why you need to invest, what to invest in, and most importantly, the specific moves I'd make if I were starting from scratch today. Let's get into it. Okay, first question. Why should you even invest your money? There are two massive reasons. First, inflation is eating your money alive. The Federal Reserve targets about 2 to 3% inflation per year. That means if you're just leaving money in a regular checking account earning nothing, you're losing buying power every single year. Here's a real example. 6 years ago, a Chipotle burrito cost about $8.50 today. It's closer to $12. So if you had $50,000 in 2019, you could have bought 5,882 burritos. Today, that same $50,000 only buys you 4,166 burritos. That's 1,700 fewer burritos just gone because of inflation. Now, I don't know what you'd do with 1,700 burritos, but my point is clear. Your cash is losing value every year if it's not growing faster than inflation. The stock market historically returns 8 to 10% per year. So if you invest, you're not just keeping pace with inflation, you're beating it and actually growing your wealth. The second reason is compound interest. This is where the magic happens. Let's say you invest $1,000 and it earns 10% per year. Year one, you make $100. Not bad, but not life. Year two, you earn 10% on $1,100. So now you've got $1,210. By year 20, that original $1,000 has turned into $6,727. Now imagine you had $1 million earning 10% per year. That's $100,000 every single year just for having your money invested. The more money you have, the more money you make. That's leverage. All right, so why stocks specifically? Why not real estate, gold, or Pokemon cards? 3 reasons. Accessibility, predictable returns, and liquidity. Stocks are accessible. You can start investing with as little as $1. You don't need a down payment, a mortgage, or thousands of dollars up front like you would with real estate. They have predictable returns. According to the latest market forecasts, Wall Street expects the S&P 500 to hit between 7,500 and 8,000 by the end of 2026. That's a potential 17% gain from current levels. Deutsche Bank is one of the most bullish, predicting mid-teens returns driven by AI-fueled earnings growth and strong corporate fundamentals. And here's the key: the S&P 500 spends about 8.3% of all trading days at all-time highs. That's roughly 21 days per year, and new all-time highs are usually followed by more all-time highs. Finally, stocks are liquid. You could buy a share of Apple in the morning and sell it in the afternoon and have your cash back. Try doing that with a house. Real estate can take 30 to 60 days just to close a sale. Stocks, instant. Let me show you something powerful. If you'd invested $100 in the S&P 500 in 1980 and just left it alone, it would be worth over $17,000 today. Adjusted for inflation, that $100 in 1980 is worth $393 in today's dollars. So your money went up 44 times more than inflation just for being invested. That's why we invest in stocks. Now, how do you actually invest? First, you need an investment account. This is like a bank account, but specifically for buying and holding stocks. There are 2 main types: retirement accounts and regular brokerage accounts. Retirement accounts include things like a 401k or an IRA. A 401k is employers, while an IRA is individual. The big advantage: tax benefits. You either get a tax deduction now with a traditional 401k or IRA, or you grow your money tax-free with a Roth IRA. The trade-off: your money is locked up until retirement, typically age 59 and a half. Some people love this forced savings. Others hate not having access to their money. If you don't want your money tied up, open a regular brokerage account. You'll pay taxes on your gains when you sell, but you can access your money anytime. Back in the day, you'd call a stockbroker to place trades. Think Wolf of Wall Street. These days, you just sign up online at places like Fidelity, Charles Schwab, or Roth. They act as your broker, and you can buy stocks, ETFs, and index funds with a few clicks. So what should you invest in? You could pick individual stocks: Apple, Microsoft, Nvidia, Tesla. And if you know what you're doing, that's fine. But individual stocks are risky and volatile. One bad quarter and the stock can drop 20, 30, even 50%. That's why most financial advisors and me recommend index funds and Here's how they work. An index fund or ETF automatically tracks a stock index like the S&P GOHEC, which is the top 500 companies in America. By buying one S&P 500 index fund, you instantly own pieces of all 500 companies: Apple, Microsoft, Nvidia, Tesla, Amazon, Meta, Google, all of them. You'll get instant diversification with super low fees. No fund manager picking stocks and charging you for it. The fund just automatically tracks the index. Now, a popular S&P 500 ETF is ticker symbol VOOTHA. Vanguard S&P 500 ETF, it has an expense ratio of just 0.03%. Meaning for every $10,000 you invest, you pay $3 per year in fees. That's nothing. Other popular options include SPY, SPD, RS, NP 500 ETF, IV Vida, iShares Core, S&P 500 ETF. They all track the same index with nearly identical performance. Let me show you why index funds are powerful. If you consistently invested $500 a month into the S&P GOHEC for 35 years, assuming historical 10% average returns, you'd have over $1.7 million. That's the power of consistent investing and compound interest. Now, some people want more growth than the S&P 500. If that's you, consider the Invesco QQQ Trust, ticker symbol QQQ. This tracks the NASDAQ 100, which is the 100 largest non-financial companies on the NASDAQ exchange. It's heavily weighted toward tech, over 64% tech stocks. QQQ has returned an average of 19.6% per year over the past decade, easily outperforming the S&P GOHEC ese 14.6%. If you believe in tech and AI continuing to dominate, QQQ is a solid bet for 2026. Another option is the Vanguard Growth ETF. This focuses on large cap growth stocks within the S&P GOHEC. It's outperformed the S&P 500 every single year since it launched in 2004. The trade-off? Higher volatility. When the market dips, growth stocks get hit harder. But over the long term, the returns are stronger. Here's my advice. If you're just starting out, go with a simple S&P 500 index fund like VOO. Once you have that foundation, you can add more aggressive growth funds like QQQ or VUG. Now, when should you invest? The answer is as soon as possible. Don't try to time the market. A lot of beginners think, the market's too high. I'll wait for a dip. But here's the thing, the market hits all-time highs constantly. And studies show that missing just 10 of the best days in the market over 30 years can erase 54% of your gains. Miss 20 days, you lose 73% of your gains. Miss 30 days, you're down 83%. Time in the market beats timing the market. Every single time. Nick Majuli, a famous financial blogger, has an article called Just Keep Buying. His main point: don't worry about whether now is the right time. Just keep buying. Market high or market low. Just keep buying. He analyzed decades of data and found that even if you bought at an overvalued price, as long as you held for 20 to 30 years, you still came out ahead. Over any 20-year period, U.S. stocks have never had negative real returns when including dividends. Here's a crazy example. In 2012, tons of articles said the market was overpriced by 50%. Back then, the S&P 500 was at 1,400. Today, it's over 6,800. That's 4.5 times higher. If you'd waited, you'd have missed massive gains. So, the best time to invest was yesterday. The second best time is today. How should you actually invest your money? Lump sum or dollar cost averaging. Lump sum means investing it all at once. Dollar cost averaging means investing a fixed amount at regular intervals. Both work, but I prefer dollar cost averaging for most people because it takes the emotion out of investing. Instead of investing $12,000 all at once and freaking out if the market drops the next day, you invest $1,000 every month for 12 months. When prices are high, your money buys fewer shares. When prices are low, your money buys more shares. Over time, you average out your purchase price. Even better, automate it. Set up automatic transfers from your checking account to your brokerage account and let it run on autopilot. Set it and forget it. How much money should you invest? Here's my take. If you're making a consistent income and you can set aside a portion each month to invest regularly, you'll see the best results. I personally started investing when I was making about $55,000 a year. I'd put $100 to $200 a month into my accounts. Whenever I got a bonus or tax refund, I'd invest that too. If you're a teenager or fresh out of college with only $100 to your name, maybe investing isn't the priority yet. Focus on building your income and skills first. Once you have consistent cash flow, then start investing. The key is consistency. Small amounts invested regularly beat large amounts invested sporadically. Now, you need to understand your own risk profile. Are you someone who can handle big swings in your account? Or do you panic when your portfolio drops 10%? If you're young, say, in your 20s or 30s, you can afford to take more risk. Even if you lose money in a market crash, you have decades to recover. If you're older, say, in your 50s or 60s, you want to be more conservative because you need that money soon for retirement. A general rule: the younger you are, the more aggressive you can be. As you get older, shift towards safer investments like bonds and dividend-paying stocks. But here's the thing: investing carries risk. Some years you'll be up 20%. Some years you'll be down 20%. In 2020, during COVID, the market dropped 30% in a month. But if you stayed invested, you recovered and made even more. The key is long-term thinking. Don't panic sell when the market drops. That's when you actually lock in losses. Stay the course. All right, if I was starting from scratch in 2026, here's my exact game plan. Step 1. Open a Roth IRA or a regular brokerage account with Fidelity, Schwab, or Robinhood. I prefer Fidelity or Schwab for their customer service, but Robinhood is the easiest for beginners. Step 2. Invest in VOOTHA, Vanguard S&P 500 ETF. This is my core holding. Consistent, diversified, low fees. I'd put 70% of my money here. Step 3. Add some growth with QQQTHA, Invesco Nasdaq 100 ETF. This gives me more exposure to tech and AI. I'd put 20% here. Step 4. Keep 10% in cash or a high-yield savings account for emergencies. You'll never want to be forced to sell your investments because of an unexpected expense. Step 5. Automate everything. Set up automatic monthly transfers. Invest consistently, whether the market is up or down. Step 6. Keep learning. The more you understand about investing, the less scary it becomes. Read books, watch videos, follow financial news. That's it. Simple, effective, and proven to work. So there you have it. If I were starting to invest in 2026, this is exactly what I'd do. Invest in low-cost S&P 500 index funds like VOO, add some growth with QQQ, automate my investments, stay consistent, and never try to time the market. Do this for 20, 30, 40 years, and you'll build serious wealth. If this video helped you, hit that like button and subscribe to Finance Flash. Drop a comment. Are you investing in 2026? What's your strategy? All right, let's build that wealth. I'll catch you in the next one.